All right, let's dive into some AmiBroker code.
Oh, yeah.
You've given us quite a bit here.
Yeah.
Looks like presentation slides and a video,
Yeah.
probably from some sort of training, maybe on AmiBroker code analysis.
Right.
So let's unpack this and see what kind of gems we can unearth for you.
Yeah, it's like someone's handing us the blueprints to their trading machine and saying, let's see if this thing really works.
Exactly.
Yeah.
And understanding this code isn't just for the tech wizards, whether you're back testing or tweaking an existing strategy or about to go live. Knowing what's going on under the hood can save you a lot of headaches.
Absolutely.
And potentially some serious cash.
Yeah, you wouldn't drive a car without understanding the basics right.
Right.
AmiBroker code is the engine of your trading strategy.
Right.
So let's start with this options section.
Okay.
That's where you set the foundation for everything else.
Okay, so it's like making sure our trading engine is tuned up and ready to roll.
Yeah.
What kind of pitfalls are we looking for here?
Well, one of the biggest traps traders fall into is setting the wrong initial equity. Imagine backtesting a strategy with $1 million account when you only have $50,000 to invest.
Right.
Your results are going to be wildly off.
That's setting ourselves up for disappointment.
It's like test driving a Ferrari when you can only afford a used Honda.
Right.
Another thing to watch out for is max open positions.
Okay.
Some traders think the more positions, the better.
Right.
But spreading yourself too thin can actually increase your risk.
So it's about finding that balance between diversification and being able to manage all those trades effectively.
The sweet spot is between 20 and 25 positions.
Okay.
Think of it like juggling.
Yeah.
Too few balls and it's boring.
Right.
Too many and you'll drop them all.
I love that analogy.
Yeah.
So we've got our initial equity dialed in. We've got our max open positions dialed in. What else should we be scrutinizing in this options section?
There are a few more key parameters that can make or break a strategy if they're not set correctly. First up, commissions.
Okay.
We need to be using real-world commission fees in our back tests.
Yeah.
Otherwise, our profitability calculations could be way off.
Right. No more pretending commissions don't exist.
Right.
Got to face the music.
Yeah.
What else is lurking in these options?
Things like set trade delays, buy price, sell price, adjusted tick size. All these little settings control how your trades are actually executed.
Okay.
If they're not aligned with your broker's rules and the market you're trading,
Right.
you could end up with orders that never get filled or slippage that eats into your profits.
Okay, so it's like making sure all the gears in our trading machine are meshing smoothly. What about this limit trade size as a percentage of entry bar volume setting? What's that all about?
That's a way to avoid entering trades that are too big for the market to handle.
Okay.
Imagine trying to buy 1 million shares of a stock that only trades a few thousand shares a day.
Yeah.
Your order is going to get stuck.
Makes sense.
Yeah.
So we're keeping an eye out for any settings that could cause execution problems down the line.
Right.
This is where a deep understanding of the code really pays off.
Absolutely. It's like knowing how to read a map before you set off on a journey.
Right.
You might stumble upon a hidden path that others miss.
All right, we've laid the groundwork with options.
Okay.
What's the next stop on our code analysis adventure?
Let's move on to market classification.
Okay.
Or MKC.
All right.
This is where we define the specific conditions under which our strategy will trade.
Okay.
Think of it like setting the rules of the game.
Okay, so it's not just about having a great trading idea. It's about knowing when to apply that idea.
Exactly. And this is where things can get tricky.
Yeah. Okay.
You might have a brilliant strategy for bull markets. But if your MKC conditions are poorly defined, you could end up trying to use it in a bear market.
Yeah.
And that's a recipe for disaster.
Like trying to wear a swimsuit in a snowstorm.
Exactly.
Not going to end well.
Yeah.
So how do we make sure our MKC conditions are actually aligned with our strategy?
One key principle is mutual exclusivity.
Okay.
Your MKC conditions shouldn't overlap. Imagine having one condition for high volatility, another for low volatility.
Right.
But those conditions aren't clearly defined.
Yeah.
You could end up with situations where both are true and your strategy gets confused.
It's like telling your trading system to turn left and right at the same time.
Exactly.
It's going to stall out.
Yeah, the presenter emphasizes the importance of testing your MKC conditions with a simple fixed position size first, like 5% of your equity.
Gotcha.
This helps you isolate the performance of your MKC logic. before you introduce more complex elements.
Okay, so we're testing the foundation before we build the whole house on top of it.
Yeah.
What else should we be on the lookout for
in
this MKC section?
The presenter suggests
Okay.
keeping your base MKC conditions to a manageable number.
Okay.
Ideally a 3x3 matrix or even smaller.
Okay.
Think of it like a chessboard.
Yeah.
Too many squares, and the game gets too complicated.
Gotcha.
You can always combine those base conditions to create more specific scenarios, which are called merged MKCs. But the presenter leans towards simplicity.
Okay.
If you can achieve similar results with fewer conditions, why overcomplicate things?
That's a mantra I can get behind.
Right. Less complexity generally means fewer chances for something to go wrong.
Absolutely. Speaking of things going wrong.
Yeah.
The presenter seems to have found some potential issues with the merged MKCs in this example code.
They're questioning whether the high volatility and low volatility conditions are truly mutually exclusive. They're foreshadowing that this might lead to problems later on.
Right.
Particularly in the position size section.
Ooh, a bit of a cliffhanger.
Right.
We'll have to keep an eye out for that.
Yeah.
Okay, so we've set the stage with options. We've defined our market conditions with MKC and maybe spotted some potential trouble brewing.
Yeah.
Where do we go from here?
Now it's time to dive into the heart of the strategy. The signals section.
All right.
This is where we define the specific criteria that trigger our buy and sell orders.
Okay.
It's like programming the brain of our trading machine.
Let's crack open the code and see what makes this thing pick.
Right.
What kind of insights is the presenter offering in this signals section?
First and foremost, they emphasize that signals should be built from a combination of price, volume, and indicator data.
Okay.
It's like cooking a delicious meal. You need the right ingredients and the right proportions.
And I'm guessing the parameter values for those indicators are crucial too?
Exactly. Those parameters need to make sense for the time frame of your strategy.
Right.
If you're trading on a daily chart, using parameters that are based on 5-minute data, it's like trying to measure a whale with a ruler.
Okay, so we're looking for signals that are tailored to the time horizon we're trading.
Right.
What about the number of buy and sell conditions? Any guidelines there?
The presenter suggests limiting yourself to less than 10 buy conditions and 10 sell conditions.
Gotcha.
Too many conditions can make your signals overly complex and less reliable.
Right. We want to keep things focused and avoid getting lost in the weeds.
Yeah.
The presenter also mentioned something about understanding which signals should be mutually exclusive and which can overlap.
Yeah.
Can you expand on that a bit?
Think of it like a traffic light.
Okay.
Red and green signals can't be on at the same time.
Right.
That would be chaos.
Yeah.
But you might have other signals, like a pedestrian crossing signal, that could be active at the same time as a red or green light.
Okay, so it's about understanding the logic behind those signals and making sure they don't contradict each other.
Exactly.
The presenter also had a helpful tip for avoiding buy and sell signals triggering simultaneously.
Right. They recommend using exactly opposite conditions for your buy and sell signals whenever possible.
Gotcha.
This ensures that you're not sending mixed messages to your trading system.
It's like making sure your car's accelerator and brake pedals don't get stuck together.
Exactly.
That would be a wild ride.
Yeah.
So we're analyzing the code to make sure those signals are clear and consistent. Anything else we should be watching out for?
The presenter highlights a couple of big no-nos. First, be careful not to over-optimize your signal parameters.
Right.
If you tweak those parameters too much, you might end up curve-fitting your strategy to the historical data.
Right.
Which can lead to disappointing results in real-world trading.
It's like creating a costume that fits perfectly for Halloween party, but then falls apart the next day.
Exactly.
That can beware of data snooping.
Right.
This is essentially using future information to create or refine your signals.
It's like peeking at the answers to a test before you take it. You might get a good grade, but you're not actually learning anything.
So we're looking for any sneaky bits of code that are referencing data that wouldn't have been available at the time the signal was generated.
The presenter gives the example of using ref +1.
Okay.
If you see that in your signal code, it's a red flag that you might be data snooping.
Duly noted.
Okay.
Okay, so we're avoiding over-optimization and data snooping. What's the last piece of wisdom from the presenter in this signals section?
They emphasize the importance of sensitivity analysis.
Okay.
This means testing how your signals respond to changes in their parameters.
Okay, so if we tweak those parameters a bit,
Yeah.
does the performance of the strategy completely fall apart, or is it relatively stable?
Exactly.
Okay.
Sensitivity analysis helps you understand how robust your signals are.
Gotcha.
It's like stress testing a bridge to make sure it can handle heavy traffic.
We've covered a lot of ground with options, market classification, and now signals. What's the next stage of our code analysis adventure?
Now it's time to tackle the position section,
Okay.
which is all about how much capital we allocate to each trade.
Okay, so this is where we figure out how much we're actually putting on the line for each trade.
Exactly. And this is where things can get really interesting.
Okay.
Because even a small change in position size can have a big impact on your overall results.
Okay, what kind of red flags should we be watching for in this position section?
The presenter starts off with a big flashing warning sign.
Okay.
Avoid aggressive position sizing.
Okay.
Anything over 10% of your equity per position is considered too risky.
Right.
You don't want to blow up your account on a single bad trade.
Right. That's like betting your entire life savings on a single spin of the roulette wheel.
Exactly.
Not a good idea.
The ideal range
Yeah.
is between 3% and 7%.
Okay.
Think of it like building a sturdy house.
Uh-huh.
You want a solid foundation that can weather any storm.
Okay, so we're aiming for a balanced and sustainable approach to position sizing. What about that max open position setting we talked about earlier? Does that come back into play here?
Absolutely. Your position size and your max open positions need to be aligned.
Right.
If your max open positions is 25 and your position size is 5%,
okay,
you're essentially allocating your entire equity across those 25 positions.
Right, so it's like making sure our trading engine isn't overloaded.
Exactly.
We need to make sure there's enough fuel to keep everything running smoothly.
And remember, you might not always get a full fill on your orders.
Right.
So the presenter suggests adding a bit of a buffer to your max open positions to account for potential partial fills.
Right.
It's like leaving a little extra room in your suitcase when you travel.
I love that analogy.
Just in case you pick up some souvenirs along the way.
So we're not just setting a fixed position size.
Right.
We're also considering the dynamics of the market and how that might affect our actual trade execution.
Exactly. And once you've got your position size and max open positions in sync, the presenter stresses the importance of testing your strategy's sensitivity to position sizing. You want to make sure that even if you adjust your position size slightly, it doesn't lead to wild swings in your results. It's like making sure your car suspension can handle a bumpy road.
So it's about finding a position size that's not only optimal, but also robust.
Right.
And doesn't make the strategy too fragile.
Exactly.
What about those complex position sizing strategies? Any tips for navigating those?
The presenter advises against using nested if conditions that go beyond 2 levels deep.
Okay.
It's like trying to follow a recipe with too many sub-steps.
Yeah.
You're bound to get lost.
Okay, so no going down a rabbit hole of if this, then that, but if this other thing, then something else.
Right.
Got it.
Now, beyond simple percentage-based position sizing, the presenter introduces a fascinating concept called position score. This allows you to prioritize your entries when the number of signals exceeds your max open positions.
So if I have 50 signals but can only take 20 positions, positions score helps me choose the best 20.
Precisely. You can use all sorts of factors, like recent performance, volatility, or even fundamental data to rank your potential trades and focus on the highest probability setups.
That's a really smart way to refine our entry decisions and make the most of our limited trading capacity.
Yeah.
But I'm guessing there's a catch, right?
There's always a trade-off.
Okay.
The more open positions you have, the less impact position score will have.
Okay.
If you're already using your entire max open positions, you're taking every trade that comes your way.
Right.
So there's no room for prioritization.
So if we want to use position score effectively,
right,
we need to make sure our max open positions is set appropriately.
Yeah.
It's all about finding that balance.
Now here's where things get really interesting.
Okay.
And a bit concerning.
Uh-oh.
The presenter reveals that the example code we're analyzing actually has a flaw in its position sizing logic.
Wait, what? A flaw? What's going on there?
Remember those potentially overlapping MKC conditions we talked about earlier? That issue has come back to bite us.
Oh, no.
It turns out that those poorly constructed MKC conditions are messing up the position sizing calculations.
It's like a domino effect.
Right.
One small error in one section can ripple through the entire code and cause problems elsewhere.
And this is why thorough code analysis is so crucial.
Right.
It's not just about checking individual lines of code.
Yeah.
It's about understanding how all the pieces fit together.
Right.
And making sure the logic is sound from start to finish.
Okay, so we've learned that position sizing is crucial, but we need to be careful about aggressive allocation.
Right.
And we need to make sure our MKC conditions are solid
to
avoid ripple effects throughout our strategy.
Absolutely.
What's next on our code analysis checklist?
Let's move on to the stop section.
Okay.
Which is all about managing risk and protecting your capital.
Okay.
This is where we set up the safety nets for our trading system.
Here's where it gets really interesting.
Yeah.
Tell me everything.
Okay. The presenter starts off with a golden rule that every trader should live by: always set a stop loss, even during the strategy development phase.
Okay, I get that stop losses are important for live trading.
Right.
But why bother setting them when we're just backtesting?
Right.
It's not like we're risking real money.
Think of it this way. A stop loss forces you to confront risk head on.
Okay.
Even when you're just playing around with ideas. It prevents you from getting too attached to a strategy that looks amazing in a back test, but could blow up your account in live trading.
So it's like wearing a helmet when you're learning to ride a bike.
Exactly.
You might not fall, but if you do,
right,
you'll be glad you had that protection.
The presenter recommends a maximum risk
of
2% of your equity per position.
Right.
This helps you stay in the game, even if you hit a string of losing trades.
So even if I have a large position size, my stop loss should be set to limit my losses to just 2% of my overall capital.
Exactly.
That makes sense.
And they provide some really helpful examples of how your max open positions, position size, and stop loss percentage all work together to determine your overall risk exposure.
Okay.
It's like a three-legged stool. If one leg is too weak, the whole thing collapses.
Can you walk me through one of those examples?
Sure.
I'm a visual learner.
Okay.
Seeing the numbers in action really helps me grasp the concept.
Imagine you have $100,000 in trading capital.
Okay.
And you're comfortable with having a maximum of 20 open positions at any given time.
Okay.
This means you're willing to allocate 5% of your capital, or $5,000 to each position.
Okay. So we're spreading our risk across 20 different trades.
Right.
Each with a $5,000 potential loss.
Now, to limit your risk per trade to that 2% target or $2,000, you would need to set your stop loss 40% below your entry price.
Okay, so 40% of $5,000 is $2,000.
Exactly.
Got it. What if we took a different approach? Say 10 open positions with a 10% position size and a 20% stop loss.
Okay.
Wouldn't that achieve the same $2,000 loss per trade?
You're right. The per trade risk might be similar on the surface.
Okay.
But the problem is that you're now concentrated in fewer positions. If all 10 of those positions hit their stop losses simultaneously, you'd be down a whopping $20,000 or 20% of your capital.
Ouch, that's a much bigger hit to our portfolio.
Right.
So spreading the risk across more positions with a smaller position size and a larger stop loss percentage really does make a difference in the long run.
Exactly, and this is just one example.
Okay.
The key takeaway is that you need to find the combination of max open positions, position size, and stop loss. That aligns with your personal risk tolerance and trading style.
Okay, so we've got our stop losses in place.
Okay.
What else do we need to know about the stop section?
Right.
Any specific AmiBroker functions or parameters that we should be paying close attention to?
The presenter dives into the apply stop function, which is the code that actually implements your stop loss strategy in AmiBroker.
Right.
They specifically recommend setting the exit at stop parameter to 2 for better control and flexibility.
I'm curious about the difference between 1 and 2 for that parameter.
Okay.
What's the practical implication of choosing one over the other?
A value of 1 means AmiBroker will exit the trade.
Okay.
As soon as the stop loss price is hit.
Okay.
Even if it's just a brief intraday spike.
Okay, so that could lead to us getting stopped out prematurely?
Right.
If the price quickly bounces back.
Exactly.
Okay.
But setting exit at stop to 2 tells AmiBroker to wait until the next day's opening price to exit the trade, even if the stop loss was triggered during the previous day's trading.
Gotcha.
This gives your trades a bit more breathing room and can help avoid those frustrating whipsaw exits.
So it's like giving our trades a chance to prove themselves before we pull the plug.
Exactly.
I like that.
Yeah.
Any other insights on this apply stop function?
The presenter briefly mentions the volatile parameter, which can make it tricky to track stop losses manually if it's set to 1.
Right.
They suggest leaving it at its default value of 0. For simplicity's sake.
So, unless we have a specific reason to change it, we'll stick with the default setting.
Right.
What about the activate stops immediately parameter?
The presenter recommends setting this parameter to 1 to ensure your stop loss is active as soon as you enter a trade. It just simplifies things and removes the risk of forgetting to activate your stop loss later on.
That's one less thing to worry about when we're in the heat of a trade. All right, so we've learned a lot about setting stop losses, managing risk, and the intricacies of AmiBroker's apply stop function. What's next on our code analysis journey?
Next up is the world of Monte Carlo simulation, a powerful technique for assessing the robustness of our trading strategy.
Monte Carlo.
It sounds fancy.
It's a way to move beyond simple backtesting results and think in terms of probabilities.
Is this where we get to roll the dice and see what happens?
Not exactly rolling dice. But the concept is similar. Instead of just looking at the average profit or loss from our backtest, Monte Carlo simulation lets us explore a whole range of potential outcomes, including those pesky worst-case scenarios that traditional backtesting might miss.
So we're not just assuming everything will go perfectly. We're acknowledging that there will be ups and downs. And we're trying to understand how our strategy will perform under different circumstances. Precisely the presenter stresses that focusing solely on average results can be misleading. Especially if your strategy is prone to large outlier wins or losses. It's like judging a restaurant based on its most popular dish without trying anything else on the menu. You might be missing out on some hidden gems or some major duds.
So a strategy that averages a 10% return but has a wide range of outcomes, from 50% gains to 30% losses, is very different from a strategy that consistently returns 8-12% with less variability.
Exactly. The first strategy might look great on paper. But those big potential losses could be a real gut punch. Monte Carlo simulations help us uncover these hidden risks and get a more realistic picture of the strategy's true potential.
Sounds incredibly valuable. What are some of the key things we should be thinking about when running Monte Carlo simulations?
The presenter recommends using both trade shuffling and trade simulating to get a well-rounded view of the strategy's robustness. Trade shuffling involves randomly reordering the sequence of trades in your backtest to see how sensitive your results are to the order in which those trades occurred.
So we're testing whether our strategy relies on a specific sequence of events that might not happen in the future.
Imagine your backtest shows a string of winning trades, followed by a string of losing trades. Shuffling those trades around will give you a more realistic sense of how the strategy would have performed if those wins and losses had occurred in a different order.
Makes sense. What about trade simulating? What does that entail?
Trade simulating involves injecting some real-world imperfections into our back tests. Things like missing trades, where you might not get filled at your desired price slippage, which accounts for the difference between your intended entry-exit price and the actual price you get filled at. And partially filled orders, where you only get a portion of your desired quantity.
So we're introducing some randomness and uncertainty to see how the strategy holds up under less than ideal conditions.
Exactly.
What specific recommendations does the presenter make for these simulations?
They suggest simulating missing trades at a rate of 5-15%. Slippage at 5-15% of the buy price or 2-4 tick size. And partially filled orders at a realistic rate based on your trading style and the markets you trade.
So we're not just blindly applying these simulations.
Right.
We're thinking critically about the specific parameters that make sense for our situation.
Exactly. The presenter also mentions adding some noise to the strategy's parameters during the simulation, like tweaking those moving average periods we talked about earlier.
Okay.
This helps us understand how sensitive the strategy is to those settings and whether our optimized parameters are truly robust.
So we're testing the boundaries of our strategy and seeing how much wiggle room we have.
Yeah.
That's incredibly insightful.
Yeah.
What metrics should we be paying attention to when analyzing the results of these Monte Carlo simulations?
The presenter emphasizes looking beyond just the average or mean result.
Okay.
Pay close attention to the median outcome, which represents the middle value in the distribution of results in the worst-case scenarios. Typically represented by the 5th or 10th percentile.
Okay, so even if the average return looks great, if the worst case scenario shows a massive drawdown, that's a major red flag that we need to address.
Absolutely. It's all about understanding the full spectrum of potential outcomes.
Okay.
Not just the happy path.
Right.
We need to be prepared for those inevitable bumps in the road.
Speaking of bumps in the road, does the example code we're analyzing include proper Monte Carlo simulations?
Unfortunately, no. The presenter notes that this crucial element is missing.
Okay.
Which highlights the need for further development and refinement. It's a reminder that even code that's presented as a good example might still have significant gaps and areas for improvement.
It's like buying a brand new car and realizing it doesn't have airbags.
Right.
Okay, so we've covered options, market classification, signals, position sizing, stop loss, and now Monte Carlo simulation. Is there anything else we need to dig into in this code analysis deep dive?
There's one more crucial area the presenter wants to emphasize.
Okay.
Double-checking those mutually exclusive conditions.
Wait, didn't we already cover that when we talked about MKC conditions and signals?
Right.
Why are we revisiting this again?
It's that important.
Okay.
The presenter dedicates a separate section to this topic to really drive home its significance. They specifically revisit those potentially overlapping high volatility and low volatility conditions in the example code.
Ah, right. Those conditions seemed a bit iffy, like they might overlap under certain market conditions.
Exactly. And the presenter doesn't just rely on intuition.
Okay.
They show us how to use AmiBroker's filter and exploration features to put those conditions to the test.
Gotcha.
It's like using a magnifying glass to examine those conditions up close and personal.
So we're not just eyeballing the code and hoping for the best.
Right.
We're using the platform's tools to objectively verify whether those conditions are truly mutually exclusive.
Precisely. And the presenter's analysis reveals that those conditions do indeed overlap.
No way.
Yeah.
So that seemingly minor issue we noticed earlier turned out to be a real problem lurking in the code.
Yeah.
This highlights why thorough code analysis is so important.
Absolutely.
We can't just assume that everything is working as intended.
Right.
We need to test and verify every aspect of our code to make sure it's rock solid.
Couldn't said it better myself.
All right, so we've identified the problem.
Okay.
Now, how do we go about fixing it?
Wow.
What steps does the presenter recommend?
Well, the source material doesn't actually show the code fix.
Okay.
But the presenter shows us how to use AmiBroker's exploration feature to pinpoint exactly where those conditions are overlapping.
So it's like a detective using forensic evidence to solve a case.
Yeah.
We're not just guessing, we're using the data to pinpoint the problem.
Exactly. They create a custom exploration column that flags these overlaps visually.
Okay.
It's a brilliant technique that anyone can use to test their own code for similar issues.
Okay, so even though we don't get to see the fix in action, we've learned a valuable method for identifying these kinds of hidden problems.
Absolutely. And this example really drives home the point that even seemingly small errors can have a big impact. Remember, this flaw in the MKC logic could potentially cascade through the entire strategy, affecting position sizing, trade entries, and exits, and ultimately our profitability.
It's a reminder that we need to be incredibly thorough and meticulous when analyzing our code.
Absolutely.
And no stone left unturned.
The presenter also uses these same tools to analyze other aspects of the code.
Okay.
For example, they show us how to calculate the average position size of the strategy.
Wait, why do we need to calculate that? Isn't position size something we set ourselves in the position section?
It is.
Yeah.
But remember, this example, code uses dynamic position sizing, where the actual amount invested can change based on those MKC conditions and other factors.
Right. So even if our base position size is 5%, the actual position size for each trade could be higher or lower.
Exactly.
Depending on how the code is interpreting those market conditions.
And knowing the average position size across all our trades helps us understand the true risk profile of the strategy.
Makes sense.
Yeah.
If we think we're risking 5% per trade, but the average is actually closer to 8%, that's a big difference.
How does the presenter go about calculating this?
Yeah. How do they do it?
They use the exploration feature to display the position size for each trade, then use AmiBroker's built-in functions to calculate the average across all those trades. It's a simple but effective way to get a handle on our true risk exposure.
So we're not just relying on a single number. We're looking at the bigger picture and understanding how our position sizing is actually playing out in practice.
The presenter doesn't stop there. They also show us how to determine how often each of those individual base MKC conditions is being met.
So this is about understanding which market conditions our strategy is most likely to encounter. If we have a strategy that's designed for trending markets, but our analysis shows those conditions are only met 10% of the time, that's a problem.
Exactly. It's like having a car that's built for off-roading. But you spend 90% of your time driving on paved roads. You're not using the vehicle to its full potential.
So we need to make sure our strategy is aligned with the reality of the markets we're trading. How does the presenter go about calculating these MKC counts?
They use a similar approach to the average position size calculation, relying on those powerful filter and exploration features in AmiBroker. They essentially set up filters for each individual base MKC condition, and then see how many trades were generated under each filter.
So we can see, for example, how many trades were triggered by the high volatility condition versus the low volatility condition.
Exactly.
This gives us a really clear picture of which market conditions are driving our strategy's performance.
Precisely. It's about gaining that deeper level of understanding that goes beyond just looking at the surface level backtesting results.
So we've learned how to use AmiBroker's filter and exploration features to test for mutually exclusive conditions, calculate the average position size, and determine how often each base MKC condition is being met. What's the key takeaway for our listener here?
These tools are incredibly powerful. Don't just rely on basic backtesting. Dig deeper, get your hands dirty with the code, and use these techniques to really understand what's driving your strategy's behavior.
It's like being handed a set of X-ray glasses that allow us to see through the surface of the code and understand the inner workings of our strategy.
We've journeyed through the options section, market classification signals, position sizing, stop loss, and Monte Carlo simulation. And we even got to see those powerful AmiBroker analysis tools in action. But what does it all mean? What are the big picture takeaways we want our listeners to remember?
All right, let's zoom out and bring it all home.
So the overarching message here is that understanding the logic behind the code is just as important as the code itself. We can't just blindly copy and paste someone else's code or tweak parameters without knowing why we're doing it.
We need to be thinking critically about every line of code and how it contributes to the overall strategy.
Absolutely.
What are some key areas where this kind of critical thinking is especially crucial?
Those mutually exclusive conditions are a prime example we saw firsthand, how a seemingly minor overlap can lead to unexpected and potentially catastrophic results.
And we learned how to use those filter and exploration tools to put those conditions to the test and make sure they're airtight.
Another crucial point is aligning your position sizing strategy with your overall risk tolerance and trading style. No point in building an aggressive high-stakes strategy if you're a conservative trader who values capital preservation.
Find a position sizing approach that lets you sleep well at night.
Exactly.
And speaking of sleep, how about a quick recap of those key principles and best practices for AmiBroker code analysis?
First and foremost, make code analysis an ongoing habit, not a one-time event. Weave it into every stage of your strategy development.
It's like brushing our teeth. We should be analyzing our code regularly to keep it clean and healthy.
Approach your code with a healthy dose of skepticism and curiosity. Don't just blindly trust the backtesting results. Dig deeper, ask questions, and challenge your assumptions.
And don't be afraid to use those amazing tools that AmiBroker provides.
Right.
Those filter and exploration features are like having a secret weapon in our trading arsenal.
Remember, trading is a human endeavor, even when we're using algorithms. Build a system that reflects your personality, your risk tolerance, and your trading goals.
It's like choosing the right outfit for a special occasion. You want something that fits you perfectly and makes you feel confident.
And lastly, remember that code analysis is a journey, not a destination.
Okay.
There's always something new to learn, something to improve, and new ways to challenge yourself.
Beautifully said.
Thanks.
So what's the final piece of advice you would give to our listener who's embarking on their own AmiBroker code analysis adventure?
Be patient, be persistent, and most importantly, have fun.
Yeah.
It's a challenging field, but it's also incredibly rewarding to build something that works and see your ideas come to life.
Couldn't agree more. A huge thank you to our expert for sharing their insights.
It's my pleasure.
And guiding us through this fascinating deep dive into AmiBroker code analysis.
Glad to be here.
And to our listener, remember to check out the show notes for links to those resources mentioned today.
Yep.
Happy coding, and until next time, may your trades be ever in your favor.